Hello and welcome everyone to our latest webinar on smarter market making. I'm Pat Gardner from the OptionsCity Business Development Team. I'm joined by my colleague Andrew Lisy, Algo Product Manager here, and Scott Morris of Morris Consulting. And what we're going to do here is walk you through this webinar on smarter market making. Andrew's going to get started and talk a little bit about OptionsCity Freeway, which is the basis and the platform that Scott developed his predictive underlying based on the market structure algorithm in, and Andrew will get started here and give us just a little basis for this. Go to the next slide. You can see just a little bit of information here about OptionsCity and about Scott's background. And in a moment here, you can go ahead to the next one. There's a brief disclaimer there that I think we missed, but everyone can take notes on the disclaimer. And I'll pass it right now, right over to Andrew to kind of lay the foundation of what OptionsCity Freeway is and the Algo store where algos like Scott's can be purchased.
Great, thanks Pat. For those of you that have joined us for previous webinars, you're probably familiar with OptionsCity Freeway. For those of you who have not, OptionsCity Freeway is an algorithmic trading engine that was developed by OptionsCity about 2 years ago. The genesis behind Freeway is that OptionsCity, from our beginning, has created a software for server-side trading. And the idea is that all of the important logic happens on the server side, and up until about 2 years ago, clients would access that server-side logic using our all-in turnkey software called Metro. Over the years, we had a lot of customers that really liked a lot of that server-side functionality and had a lot of really great ideas on how they would want to extend it themselves and build in some of their own trading logic. So in response to that, we created Freeway, which essentially takes all of that core server-side logic that runs, very highly optimized, very fast, and gives the users the ability to write their own direct algorithms to take advantage of that. So instead of having to do everything from interface with the exchange and risk management and quoting logic and all of that, with Freeway you can leverage all of that capability that's been used and tested by OptionsCity for a number of years, and then extend that and build on your own platform on top of that. One of the very interesting and exciting components of Freeway is the idea that you can very easily plug in your own algorithms as well as algorithms written by others. So to facilitate this, OptionsCity launched about 1.5 years ago our Algo store. And the idea with the Algo store is basically developers like Scott and like others around the world have the ability to write algos to Freeway and then put them in our Algo store, where they can then connect with other traders in similar markets that are looking for algos of their own. Obviously, a common question that people have is, why would you write an algo? If you have a great algo, why would you write it and put it in an algo store instead of just running it yourself? And I think the best answer to that is the idea that there's really a whole spectrum of automated trading algos. Everything from really top secret money making algos that firms guard with their lives, all the way down to kind of more commodity type algos, hedging algos and skew manipulation and volatility management algos. And I think really the sweet spot that a lot of people have found is those algos that might not do everything and all things to them for them every day, but instead really just facilitate better trading and smarter trading for their customers and also for themselves. So with that, Scott has developed an algo that takes advantage of this unique feature of our Algo store. And what Scott's algo does is basically takes our pricing engine and uses a smarter price, a micro price for it to drive the options valuation. So as you can see, the pricing engine has a number of ways that you could potentially tweak it. You see the kind of the standard ones like skew and volatility path, risk path, as well as everything related to targeting and quoting. These are all the different ways you can potentially go and modify it. And as I said, Scott really focused on the underlying section of it. So just a very brief intro to kind of what this looks like in our system, and then I'll hand it over to Scott, who can really get into kind of the nitty-gritty. But essentially the idea is the market data from the exchange comes right into our pricing engine, and before it hits the pricing engine, Scott's algo, which runs server side and is connected directly to that pricing engine, takes that market data and generates a different underlying value, a smarter underlying value in some sense. From here, we essentially use our pricing engine to price all of the options that the user is currently connected to, and this will drive everything from quoting to target missions to hedging. And the idea being that with a better underlying, with an underlying that's a little more predictive, you can then get smarter, better option pricing. So with that, I'll hand it over to Scott to talk about his fast futures algo and walk us through a little bit of that.
And as another housekeeping note, everyone is encouraged to ask any questions along the way in the dashboard there, and we'll be able to either take some of them live probably, as well as kind of answer some of them at the end of the presentation as well.
Well, thank you, everybody. Thank you, Andrew and Pat and Sarah and Deanna and all the OptionsCity team. It's really a pleasure to be here and working with them on what I think is a really exciting innovation and that is the Algo store. Having teams like mine that can add algorithms for sale is wonderful. Thank you for doing that. So briefly, what I've developed, my first algo for the Algo store is the fast futures algorithm, and sort of the thinking behind this is that a lot of effort has been spent on the modeling side on implied volatility as a source of edge, but really not as much has been done on the underlying side. And the claim is that for very short periods of times over a second horizon, your underlying price is actually more volatile than your volatility. And so it makes sense to at least think about what is the right underlying price to use and see if you can add some rigor to that, some statistics, then you can perhaps add a little additional edge to your model, to your trading profits. Okay, so what the fast futures algo is, it's a short-term futures, a forecast for the futures, specifically engineered for option traders. And what I mean by this is it looks at over a short time horizon. It's not trying to come up with a futures forecast that's going to have you accumulate deltas. It's going to come up with a forecast that's going to answer the question, what is the best price to use for me to price my options effectively right now? What's also exciting about this algorithm, there's this hidden source of speed attached to it. So there are efficiencies that it creates in processing information, and there's also this issue with exchange latency. And I'll talk about in detail in the future how the model gets around that, and with software as opposed to hardware, you can actually increase your performance speed. Okay, so what are the benefits? The fast futures algorithm creates a faster and smoother adjustment process for your underlying. It will reduce your pick-off risk, improve your queue position. So again, it's the hidden speed component and the efficiency of the pricing. It's going to get you in the right spot quicker and at a better price than the current algorithm. And hopefully, ultimately, it will improve edge retention.
And this algo's on the Algo store right now, Scott?
As of today, freshly on the Algo store today. I checked just before and it was there. So
okay, great.
People can, if they want more information, they can certainly look there. So as Andrew mentioned, sort of how does the algorithm work? Well, it's based on this class of modeling called microprice. Microprice is sort of a part of a larger sort of academic literature called microstructure analysis. It's been around for 20 or 30 years. I'd like to say I invented it, but I did not. I think Joel Hasbrook from New York University is probably the father of it. But what it does and what my model does is it takes tick-by-tick data and it adds some statistical analysis to it. So in this case, I built this model specifically from the OptionsCity real-time price feed. It's sort of an important distinction because data streams are all different, and having one that's data that's modeled on the same one that the trading platform is designed on is important. So the main driver for this is called a microprice, which is just an expected value of the futures over a very short period of time. The reason I don't say over a specific part of time, it's based on the arrival of information. So, and I look ahead a certain number of trades to come up with my prediction. And in a nutshell, the microprice is simply a function of current information about that particular instrument. The bid price, the ask price, the sizes of both, and the recent trade history.
The trade history, is that the last trade specifically, or is that?
It is. If you notice here in the equation here that there's the variable trade adjust. And what's interesting about this model, why it's geared or engineered specifically for option trading, is that the components are all sort of adjustments off the midpoint. So if you don't have, if you're just using the current Metro software, you're going to be using what's basically the midpoint. You're going to be using the current market bid in the ask. Using the midpoint in this model, you would be using that. And the two components that are added onto it, the two statistical components, one has to do with the size ratio, and the other one has to do with the past trade history. So to answer your question, it's not necessarily the price of the trade, but it captures the momentum, whether it was a trade that was up or a trade that was down. So the advantage of that is that it's all centered on the midpoint. If you have it price-based, then it can actually add a lag to it because prices are going up and it has a moving average of the lags. So this says if it traded on the offer side 5 times in a row, it's going to predict it's going to trade on the offer side again. Okay. So I'll go into more detail on that in a minute. And the other component, and there's the sigma there, it says that there are a different number of lags. So it's model dependent, but there are a certain number of lags of the last sale information that are used. And the other component is the size component. So the betas here are optimized parameters. That's where I took the tick-by-tick data and did the analysis on, regression analysis on. And the size ratio looks at the ratio of the bid size to the ask size. It turns out that both these components are pretty strong predictors of what is going to happen in the short term. So just to add a little bit more detail to that, this graph and this graph was also on the blog I wrote for OptionsCity in their last newsletter. So if you have any specific questions about this and want more information, you can refer to that. So this graph sort of highlights the size component of the equation. So you've got the size component and you've got the trade component. So this isolates the one effect. The graph is a little messy, so let me just walk through the different lines here. The green line is just the current ask price. The red line is the current bid price. The blue line is the adjustment, and the purple bars is this ratio, the size ratio. You'll notice that the strange numbers at the bottom, these are the timestamps in milliseconds. So this is about a 15.5 second period. So it's just a small snippet of information. And what it shows here, if you compare, wait, I've got this cool pointer here. Bear with me 1 second. I can add this little guy. All right, look at this. So if you look in this area, you can see and the purple line, the purple bars use this axis here. So the ratio of the bid and the sizes is between 0 and 100%. Okay. So in this situation down here, you have a lot more ask volume as opposed to bid volume. And here you have the opposite. You have a lot more bid volume versus ask volume. Now, what this is saying then, if in this area, it's taking this forecast and the forecast is moving downward, which suggests that the expected value of this futures, this is West Texas crude, is going down. Simply because it makes intuitive sense. If there's 20 contracts on the offer and only 3 on the bid, then you would expect that there's a higher probability that it's going to trade down a tick than it's going to trade up a tick. So it just takes that intuition and kind of quantifies it. Here you can see the same thing here, where as the size is growing, the size and difference is growing. It does that right before the move up in this tick. So, and even this line, you can see it's smoother than if you would just go midpoint to midpoint or bid or offer to offer. So it has an effect of creating a little bit of a forecast as well as smoothing the adjustment process.
Take off the.
Oh, I gotta take this guy off. Excuse me. Okay. That
Go
work now?
back up to.
Technical difficulty with my technology. There we go. All right. Thank you. Okay. So this just shows the exact same thing for the trade component. And here I'm only using a model with one lag just to simplify things. And you can kind of see it's not as interesting, but you do kind of see at the very beginning you had a trade near the bid. On the bid here, and then you had a trade on the offer, and so it just gives you a little adjustment, sort of capturing that momentum. So you put these things together. So this is the full adjustment, and it has the multiple lags as well in there as well. You can see that this not only smooths the process out quite a bit, but it also is predictive. So if sometimes wrong, there's a couple instances here where it predicted wrong. But you can see clearly in instances like this, it predicts the movement of the change in the bid and offer. And what's also interesting is once the change happened, it didn't give you the full effect. It still didn't quite believe it completely that the new higher bid offer range was reached. So.
And you're comparing this to that gray line as the midpoint, right? So we're looking at the blue line is the micro price that you're calculating,
right? And
the gray point is the midpoint.
It is the midpoint. And
okay.
So if you're pricing off, if you're pricing off the offer and the bid, you have a process where it jumps and jumps and jumps, where the adjustment prices from the micro price is naturally smoother, okay? And also is in many cases predictive. It's a statistical model, so obviously it's not perfect. These microprice models are an important tool for forecasting the futures in the short term, but they're also a really great building block. If you think about implied volatility calculations, when you impute implied volatility for any kind of model, you have to make an assumption of the underlying price to use. So you can decrease a fair portion of the noise if you use the micro price as your input to that model. This type of thing is a building block also used for high frequency trading models. You need a couple $1 million worth of infrastructure as well, but sort of things like this are used extensively in high frequency trading models. Okay. Thank you. Okay. All right. So let's talk a little bit about the statistics behind the model and how well does the model work. This is a standard table of 4 different models. I've optimized models so far on the West Texas crude, on the ES Mini, on gold, and on corn. We start on the right side of the table and look at the R squared and the T statistics. These are common measures for the value of a model. R squareds in finance, anything in double digits is a pretty strong model. And this tells you how much of the error is explained by the model. So you can see in the ES Mini, we're explaining 30% of the error, in gold, 12.8. Still not bad. And the T-stats tell you the significance of the different variables. And the rule of thumb, above 2 is a significant value. So you can see all these pass the range. And just some of you people might ask, and so let me tell you a little bit about the assumptions I use to generate this data. First of all, I look ahead and my forecast, I try to predict what's called the evaluated price 10 trades in advance. Now, if you're familiar with the way the data comes in on the exchanges, one trade could be represented in multiple orders. So if 100 lot trades, it generally trades in 80 different pieces. I combine those all together, so I'm actually looking at independent events, 10 independent events in the future. I don't use overlapping data, and I optimize this just during market hours. And you can see here that the median forecast time is variable, but it is forward-looking. And it's not surprising that the ES-mini is shorter because it trades more frequently. What's really interesting about this model, if you look at the two left-hand columns, the one that says 0.2 tick signal and 0.5 tick signal, the percent right, what this does is it doesn't look at the value of the adjustment, it just says whether it's positive or negative. So if the model is predicting that the micro price is going to predict a micro price adjustment of 0.5, which means half a tick, which means that you will round up or down to the next tick. It's right almost 90% of the time for the ES, 70% of the time for oil, 65% for gold, and 87.9% for corn. Not surprising, it does the best in the models where there's a really defined Q structure in the bid and the ask. If you look at gold, the lowest T-stat there is for gold on the size ratio. It has the less predictive ability. Anybody who's traded gold knows that the bid offer size is pretty small there, and it's very variable. I will point out one additional benefit that's actually very interesting with gold. The way that the size ratio works, if you do have normally a 2-tick wide market and you have this annoying little one lot coming in the middle, the way the model works, it kind of doesn't give you the full adjustment. It really kind of dampens situations like that because it's going to say, well, there's only one there versus whatever the other size is, and it will really dampen it. So that's just a sort of a side note of another benefit of the.
Hey Scott, when you did this testing, was it during normal market hours or?
Yeah.
And you think that that's when this is going to perform the best, when there's just more liquidity in there in general?
You need a different model for overnight and less liquid products. I did do a couple tests for non-market hours, and if anybody is interested, I can easily create another model specifically for that. Because the trades are farther apart, there's less information in the last sales.
Okay.
So you just need a different. The model's the same. It's just the beta coefficients that go into the model will be different.
Okay. Scott, one thing we hear from a lot of our customers trading markets like gold is that, given the market jumps around a lot and it's a little more crazy than ES, a lot of times they feel like people are trying to game them.
Yeah.
Do you look at your algo as kind of a way to be a little bit defensive against that? Does that help in that respect?
Absolutely. We're going to talk about in the next couple slides this issue of trade-throughs, which it's impossible to actually have a trade-through when you only have one exchange and a central process for order handling process. But the way the data comes across the feed, it looks like that way. And when you're using bid offer information, you're missing a lot of times that information, that change that happens, and that's part of it. This moves the last sale component of this model will take advantage of an event like that and will move you out of the way much quicker. So, and just one last thing on this slide to give you some context of the value of, or how often do you have a 0.5 event for these different markets? This particular table was created from data from January 6th through January 17th, and let's see. So for oil, the CL number there were a total of 477 events where it was suggested there was a 0.5 tick adjustment, which for this data set that I used, it was about 9% of the time that you would see an adjustment that high. For the ES market, there was 769 events, which was about 3%. So these are frequent events. This does happen quite often, so it is worth thinking about situations like this.
Click the mouse.
Click the mouse. Okay. So how can the success rate be so high? Well, there's actually two sources of value to this model. The first one is based on the signal, which is the model, and the bid-ask ratio and the last trade momentum are predictive of short-term moves. There's a second component here that I think is, in many cases, equally important, which I've called the latency alpha. There is just a number of instances where there's natural latency inside the CME engine, and they have a hierarchy for updating information. And when there's a big trade goes through, the preference is always on trade information, and the bid offer information is updated later. So there is a natural latency between last sale and bid offer information. And part of this is structural. The CME has, they try to give the best price for a trade, and they have all these spread futures and cross-product futures, and they're looking to all those different things to try to match the price. And that just takes time. And while they're doing all that stuff, they're not updating the bid and ask information. So a major value of this model, the hidden speed component of this model, is that it overcomes that the bid offer latency by injecting a forecast that uses the last sale information. Here's just a simple example for the ES mini market to give a little bit more context to that. What I've printed out here is basically just 3 messages that came across the price feed, the OptionsCity real-time price feed, at 12:07 on some day last couple weeks ago. You can tell from the price it was not recent data. So the first line, actually this was a large trade, and I just captured the last trade event, the one lot that traded of a couple hundred, that was at the bid price. So you can see the last price there is the same as the bid price. It shows 38 contracts on the bid and 972 on the offer. So intuitively, if the last trade was on the bid, it turns out the last 5 trades that it uses in this model on the bid, and the bid size is so much smaller than the ask side. Intuitively, you would expect that a price near the bid is probably more likely to occur over the next couple seconds than the ask price, and that's what the micro price gives you here. It gives you an adjustment of 1828.739, which is just below the bid price. So it's suggesting here a half-point change based on this data. Now, what's interesting is that the middle line, which is the next record that comes across, shows a last price of below the bid. Notice that the bid size and ask size did not change. Okay, so this is impossible for there to be a positive bid, and a trade price below the bid. And it's not real. What's happened is simply that the last sale was updated and the bid offer size was not updated. So you see what looks like a trade through. The actual bid is probably lower than that, but we don't see it. So, and in this case, notice the micro price adjustment here. It's right around the midpoint of the next tick lower. So at the time of this event, the model is basically predicting the market is going to move down. The expectation of the futures is a tick lower. Now, if you look at this third line, and I've highlighted the last digits of the timestamps here. These are in milliseconds. So there was no information that came across the feed for 40 milliseconds before the bid offer was updated to reflect the new information. So for 40 milliseconds, the fast futures algorithm has made the adjustment while the current algorithm would have been waiting for the prices to update. So it creates you a smoother and a faster adjustment process. If anybody has any questions, I'm almost done, so now would be a good time to interject any thoughts you might have.
See if we have any coming through.
Okay.
And we can hit them at the end. Feel free to to type them into your question box on GoToWebinar whenever you want.
I suggest using the questions panel, although I do see one that came in the chat here.
Let's get them at the end.
We'll get them at the end. All
Okay.
right.
I'm almost done. So just quickly, sort of some specifics about the model itself. It's delivered on the Algo store. The parameters will be delivered to you, and they'll be updated frequently or every so often. There's also some customization that can go on and some safeguards in place, so that allows the user to determine the strength of the signal they want to use. Adjust the maximum allowable adjustment. There's a soft and a hard in there to make sure that no crazy values get into the system, and so there's caps in there. There's a user-defined cap, so they can make the adjustment, cap that. And there's different things to sort of improve the performance of the model against different system slowness and so forth. That's it. So currently the Algo has been optimized for these 4 different models. I wanted to create sort of a representative sample of different market structures to show that the model worked in a number of different scenarios. I've not found a liquid instrument with transparent bid and offer where a model like this cannot add value. So if anybody has any interest in any other models, I can easily create those, and I plan to roll them out throughout the as time goes on. So I priced this thing, I think, pretty competitively. The initial price will get you a two-month free trial. There's a monthly subscription fee, $175 per product. I'll be providing. I mean, these parameters are pretty consistent. But they do evolve through time, and so I will be providing updates and model enhancements too. I think we're just pretty much scratched the surface as far as functionality here. There are a lot of different additional tweaks and enhancements that we can add. So that's it. Thank you for listening. If anybody has any questions about this, feel free to reach out to me. My email is on, and my phone number there is available on, so please feel free to contact me.
I see we have one question that's come in so far saying, what would you say, would you say that on average this smooths out the underlying updates, potentially reducing the risk of QPS or quotes per second violations?
What is it?
The CME only distributes or allows you to disseminate so many quotes per second into the market.
Okay.
If you're doing too much, it's going to either throttle you, and on our system we actually help make that enforce you pointer quotes for the market, so that the throttling doesn't become dangerous.
Right. So there are a couple parameters which control that, and sorry, go back here. Well, anyway, yeah. So that's a user-defined parameter. That's if there's a small non-economic change in the underlying price, then there's no updates. Yeah, back one more. Sorry. Yeah, this update threshold calibrates the update process to preserve system responsiveness. So same thing. It will define how often it makes an adjustment. The signal trigger will set a minimum threshold. So if, say for instance, if you only care about using the model for instances where it tells you to adjust by a half a tick or more, then you can put that in there. So you'll be just using your current model. It'll pass through the current market data, and so that will control for that.
Okay.
And I think if I can interject, I think one of the interesting things about using your algo like this is that it really gives the user the ability to really determine when they want their signal to actually change. So, obviously on our side we do a lot of stuff to try to optimize QPS and things like that. But I think your algo will allow the user to just take it a step further and really dig into what's really important to them and when they actually want to change their markets versus just responding to every piece of jitter in the underlying.
Okay, question now. What would be an example of a too illiquid product or market for the algorithm not to work anymore? Great question. I think when you have an illiquid market, there are algorithms that actually help a lot more. A lot of those, the last sale information has a lot of value. So I think if you're looking at something like platinum or something like that, the problem that you have with markets like that is that the variability of the bid-offer spread, they jump around quite a bit. So it's really hard to use that information effectively because it could jump out wide and then a one lot come in and narrow it down. This market actually would work pretty good on that, pretty well on that. I think any market that there's any liquidity whatsoever that allows you to have trade information that's recent. And again, maybe you only want it when the market's busy. Maybe it's just turned off when the adjustment. But still, I mean, if you have a jumpy, the smoothing component I think really helps there. If you do have a jumpy bid-offer structure, that and one thing that I'm going to add for the illiquid market is just another parameter that I found very effective, and that is instead of using the actual bid offer to come up with a quote unquote forecasted bid and offer size, so you make the adjustments off this sort of like sort of normal bid offer width as opposed to the current one to help alleviate those problems. So.
And one of these questions, Scott says, could you please classify the types of market participants and which types you expect to be most interested in this algo? Is the obvious answer here that it's this is predictive underlying is for futures traders, and it's options traders. It's for options traders who are looking to trade around a fair value that they're defining based on this underlying and doing automation.
Yeah. I think so. I mean, if you're making markets in the futures or you're trading futures actively as a business, you need this is a building block. This will help you, but it's not enough. But it's really designed, engineered for options traders, market makers that have a two-sided position, and they make their money from the edge from the markets. They have to have an input, underlying input to value those options. This gives them a better one to do that on.
All right, and I think we have one last question here. It's a two-parter. The first part is, what does the 0.5 tick signal mean?
Sure. Based on the regression coefficients, the microprice has a continuous function between 0 and an infinity in adjustments. So what I did was capture there just a slice of all the instances when the microprice suggested an adjustment of around a half a tick. Okay, so that would be a situation where both the trade momentums and the bid component were favorable to the market moving strongly in one direction or the other. So I just took that time slice and instead of saying what was the predictive power, saying what is the success rate. When it's in that range, those numbers represented the times that when it actually was what the forecast was, so the success rate of that. So.
Okay, and the second part, our final question will be, how is the trade adjust, one of the variables you mentioned on the previous slide, defined, and how are the parameters calibrated?
Good question. Yeah, the trade adjust, again, is a relative measure. It's in relative to the midpoint. So it looks at the currents at the time of the trade came in, and it looks whether it's a positive event or a negative event, okay? And the coefficients then are able to to take that, and it's a lagged regression model, so the coefficients for the older events generally have less value than the more frequent events. And depending on the model, I see how many are significant. For some markets, it's 2 or 3. In other markets, it's out to 7. Beyond 7, it's not as interesting. So, and they're calibrated. They're calibrated through regression analysis. So I use a VWAP as my Y variable, 10 trades out in the future, and I fit a model based on that, based on using the tick-by-tick data that I pull off directly from the OptionsCity real-time data feed. So, and I'll be updating that going forward every 2 weeks or a month or something like that as more data becomes available.
All right, great. Well, that takes us just about where we wanted to end it at 45 minutes, and there's no further questions. I want to thank you again for coming in here, Scott.
My pleasure.
And kind of imparting a lot of your knowledge with us in the audience here. And everyone is encouraged to go to the OptionsCity website where they can see Scott's blog article, and I imagine from Scott's website is well up there. A recording of this webinar will be on the OptionsCity website within 24 hours of now. And if you have any other questions, feel free to contact the appropriate person on the screen you're looking at. Thanks everyone for attending, and have a great day.
Thanks everybody. Appreciate it.